Central bank sovereign physical gold buying is increasingly being sourced directly from producers and refiners, with the bulk of fiat FX gold and fiat FX silver into physical, of conversion into physical. That is actually flowing into the BRICS facing exchanges. Not coming back. Notwithstanding that central bank sovereign monetary gold purchases don't require reporting, an increasing percentage of these flows are settled outside the SWIFT messaging protocol. We looked at that last time. In fact, to escape sanctions and freshly instigated tariffs, a large barter trade is actually evolving. And of course, there is no better fungible barter benchmark than gold. And we reliably hear that Russia supplied gold to China in January by way of barter.
Market analyst Andrew Maguire reports that central banks are increasingly procuring gold directly from producers. This gold is then directed to BRICS-aligned exchanges, allowing these transactions to bypass Western financial markets. Many of these transactions now occur outside the SWIFT network, which enables settlements without the risk of sanctions. Gold's role in global trade is strengthening, highlighted by recent barter deals between Russia and China, reinforcing its value exchange status. Russia is focusing on alliances like G20, SCO, and BRICS to shift from the Western financial system. Poland's central bank notably added 90 tons of gold to its reserves, with the Czech National Bank increasing its holdings by 20 tons last year and another 1.7 tons recently. While China has slowed its gold purchases, it still holds significant market influence. Analysts expect sustained central bank demand to drive gold prices above $3,000 per ounce. Russia remains at the forefront of the de-dollarization movement, challenging Western dominance in global finance. It has consistently criticized Western policies, including freezing $300 billion in Russian assets, and has positioned itself as a leader in developing alternative economic systems. While Russian President Vladimir Putin has stated that a BRICS single currency is premature, the country has shown increasing openness to blockchain technology and digital currencies, which will likely play a role in future BRICS payment platforms. According to local reports, Russia will be piloting the use of digital gold assets for international settlements to reduce its dependence on foreign currency and payment systems. Maguire notes that rising trade tariffs are prompting BRICS nations, led by Russia, to develop independent payment networks. Whether temporary or long-term, this shift drives demand for gold as a hedge against currency devaluation and geopolitical instability, highlighting gold's critical role as a safe haven asset amid escalating global economic tensions. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
We've got 3 and a bit weeks to go. Yeah, Shane, while resistance at 3,000 is clearly apparent, hence the race by officials to cap rises into it, and we've looked at that. What we're seeing is these efforts are becoming increasingly difficult due to what we're just discussing earlier, which is the long open interest, the chips that float around the casino now populating the COMEX and the COMEX and the exchange for and the ETFs. These are longs that are seeking that exposure. To longer-term exposure to gold as this first-year asset class. And as we say, sticky and hard to rinse. That changes the game. And this enables them not to get the traction that they need to be able to maintain this scam. This will expose blinkered bid pulling and momentum-induced selling to be quickly capitalized on. And we are seeing that. Okay, it was 31 this time. This should be 33. As a pullback point, and it should be obviously on the way up to 50 plus, but obviously one step at a time. Now, from a macro perspective, central bank sovereign physical gold buying is increasingly being sourced directly from producers and refiners, with the bulk of fiat FX gold and fiat FX silver to be into physical, of conversion into physical, that is actually flowing into the BRICS-facing exchanges. It's gone. They're not coming back. Notwithstanding that central bank sovereign monetary gold purchases don't require reporting, an increasing percentage of these flows are settled outside the SWIFT messaging protocol. We looked at that last time. In fact, to escape sanctions and freshly instigated tariffs, a large barter trade is actually evolving. And of course, there is no better fungible barter benchmark than gold. And we reliably hear that Russia supplied gold to China in January by way of barter. And just as BRICS settlement platforms are being forgotten about, remember we talked a lot about them and there was a lot of toing and froing, tariffs have really sparked fresh interest in this. Russian Foreign Minister Sergei Lavrov, he recently reaffirmed, and as he put it, BRICS nations continue to discuss implementing payment platforms alternative to American ones for members of the alliance. Well, that is inevitable. The more that tariffs get rolled out, the more it impacts. And obviously, we don't know how that's going to go. And maybe this is just Trump just being strong in getting good deals. But I mean, tariffs are essentially can be interpreted as sanctions. And we've already seen Europe talking about seizing the Russian assets and one thing and another. It just isn't very helpful for the payment system. Now, so with every single liquidity provider and almost all bullion banks anticipating it's going to cost far more dollars, pounds, euros, and yens, etc., to buy the same ounce of physical gold and silver, there's only one question remaining. How well are you positioned to protect your wealth?
Silver has been in a supply deficit for the past 4 years, a trend expected to persist in 2024. The projected supply for the year stands at 1,004,000,000 ounces, while demand is estimated at 1,219,000,000 ounces. A significant portion of this demand, around 60%, comes from industrial applications, as silver is a key component in electronic devices, circuit boards, solar panels, and electric vehicle batteries. With the continued expansion of EV adoption and green energy technologies, industrial demand for silver is expected to remain strong. Silver's price volatility and weaker returns historically kept it in the shadow of gold. However, since 2023, silver has not only matched gold's performance but has outpaced it over the past 5 years, positioning itself as a more mainstream investment option. Bloomberg has recently highlighted silver's growing strength against gold, reinforcing the expectation of a breakout move. Andrew Maguire notes that intensifying supply shortages and a growing gap between paper and physical silver prices indicate a fundamental market shift. The reallocation of physical silver to BRICS-aligned exchanges and rising demand from industrial and investment sectors suggest a significant revaluation of silver is imminent. Let's get back to the interview.
The unprecedented exchange for physical spreads between spot silver, we've been looking at them over the last few weeks. I mean, this difference between spot silver and the futures markets, they're only large enough to pay for air shipping out of Loco London, 1,000-ounce supply, to New York to cover largely a massive COT, largely swap dealer, short positions. What that's doing is further tightening available global facing supply at current foreign exchange silver prices. This is a really tight situation. It's evolving into a coiled beach ball rally. Now, we've evidenced the largest COMEX physical delivery since the Hunt brothers debacle. Only this time, the bullion that's being loaded out of the COMEX is fully paid up and headed to Asian-facing exchanges where immediately deliverable physical bars are being priced significantly higher. During the Hunt brothers period, what they did was simply the bullion was still within the COMEX ecosystem. So what they simply did was say, no, you can't buy it anymore. You can only sell it. Well, clearly what happened. So everyone's aware of that game. And really now, by taking the physical out of that ecostructure, you cannot do that. And we're also evidencing large Asian spot silver foreign exchange buying as well. Now, even though foreign exchange silver is not NSFR Basel III compliant and therefore will eventually be delivered, it remains for the short term as a paper claim obligation on the seller. But once an FX silver price is locked in for $1 price, and that's currently below the current local London critical float threshold capacity to deliver, hence it's not being delivered. And given that the LBMA cartel are refusing to supply any size at current prices, it drives buyers to source silver directly from producers and refiners outside the LBMA ring fence at a premium. This is where the real globally determined supply-demand price is discovered. That means where a seller, a physical seller, is willing to offer immediately deliverable silver bullion for sale in whatever size that he is prepared to do that for. Now, given the LBMA CME cartel are still trying to hang on to the last vestiges of a 75-year centrally-controlled COMEX silver cartel price that is from 1933 to now where we are in 2025, an increasingly decentralized physical silver market has become liquid enough to prey on this fast-closing FX market arbitrage opportunity. As this decentralized process gains momentum, where a physical bar has to be fully paid for before it can be offered, this further tightens local London CME supply, but more importantly, it establishes a real physical silver supply-demand price. So it's not unusual for this to translate to plus or minus 10% premiums over spot in Shanghai. Supply shortages at current FX prices is why we've also evidenced up to $1.35 spreads to short cover naked short COMEX positions. Now, the front month most liquid May contract is still commanding a $60 premium over spot, which is far larger than it should be.
With central banks securing physical gold outside traditional markets and silver facing persistent supply deficits, both metals are gaining prominence as safe haven assets. The growing disconnect between paper and physical markets, rising geopolitical tensions, and trade realignments suggest that a revaluation may be on the horizon. What impact do you think these trends will have on the future of global trade and financial stability? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.